In the financial world, there's really only one thing that's worse than Starbucks when it comes to keeping you broke: your car. This is why you see article after article talking about why cars, especially new cars, are keeping Americans broke. But there's more to the story than this, because the whole point of having the minority mindset and thinking different than the majority of people isn't that way you're gonna live the rest of your life being cheap and frugal and not giving yourself the luxuries that you're working so hard to be able to afford. The whole point of having this minority mindset and being financially educated is so you can live life the way you want and be able to afford all the things you want. So when it comes to cars, if you're a big fan of cars and you want to be able to own a new car, you gotta know when it makes sense to buy a new car. Let me get right into today's video. Okay, if we're talking strictly financially, when does it make sense to buy a new car? The answer is never. You are gonna way overpay when you buy a new car versus a used car. I mean, you can save 20 to 40% on your car's value just by driving a car that's 1 or 2 years old. Thank you for watching. If you enjoyed this video, you can see that this video is not 1 minute long, so there must be more to it than that. Buying a new car is not the financially smart thing or the frugal thing to do. It's a luxury. You can think of it kind of like flying first class. If you were gonna fly from New York to California and you want an economy class ticket, you can do it for like $200, even less than that. But if you wanted to fly first class from New York to California, that's gonna cost you almost $900. That's a $700 difference for the exact same journey, just a different experience. If you fly on the backseat of Spirit, you're gonna get a super cheap ticket. Just make sure your backpack fits into that bin that they give you, because if it doesn't, they're gonna charge you $100 at the gate. But you're gonna get to California just like the first class ticket is gonna get you there. But it's just not gonna be as nice of an experience because you're sitting on Spirit instead of first class at Delta. There's nothing wrong or shameful about taking Spirit. It's just not as comfortable. I mean, I've taken Spirit plenty of times. Last time I flew with Spirit, I flew from Philly to Detroit, and I paid for that big seat upgrade, you know, the front 2 rows where they give you the bigger seat. Paid $35 for that. And as I was about to board the plane, I gave the lady my ticket and she says, "Oh, it looks like you didn't pay for the big seat." And I said, "Yeah, I did." I showed her the confirmation on my phone. Then she's like, "Oh, we must have a glitch in our system because we gave your seat away to somebody else." So now I didn't have a seat on the plane. They made me wait until the entire plane was boarded, and then they made me sit on a random seat, and I didn't get my money back for the big seat upgrade. I still got to Detroit just fine. It just wasn't as comfortable or enjoyable of an experience. Sometimes used cars are gonna give you more headaches. I mean, that's just the game. If you are not a mechanic or if you're not a car person, you might not be able to tell what's good and what's not good, and when you start driving the car you might realize that this car needs some work. But in general, buying a used car can save you a lot of money. Like, let's say you wanted to buy yourself this brand new $50,000 car. Oh yeah, the minute you drive this car off the lot, you are gonna lose $5,000 worth of value. So in 1 minute, the value of this car is gonna drop from $50,000 to $45,000. In 1 year, the value of this car is gonna drop another $5,000 to $40,000. In 2 years, so 2 years after buying this, the value of your car is gonna drop to $34,000. And in 5 years, this car that you paid $50,000 for is gonna drop in value to $20.5 thousand, so $20,500. If you finance this car, it's gonna run you at least $600 a month. So you paid $50,000 for the car, but if you just bought it a couple years later, you could buy this once $50,000 car for just $34,000, and you can avoid paying the $600 a month. You can compare doing this to buying a used car. So to get the $600 monthly payment, I assumed that you put $6,000 down in order to buy this car. If you took that $6,000 and instead of putting it down to finance this car, let's assume you buy yourself a nice but good working $6,000 used car with cash. Now you have no monthly payments, and now you can pay yourself $600 a month. Now, after a year, you're gonna have an extra $7,000 in your pocket that you can use with your $6,000 car to buy yourself a brand new, even nicer car. Just do the math. Instead of you paying the $600 a month to your car company or to your bank, let's assume they're just throwing this money into your bank account, your savings account. Every single year, you're gonna throw an extra $7,000 into your bank account because this is money you don't have to pay your car company. So in 1 year, you'll have $7,000. In 2 years, you'll have just over $14,000, and you're driving a $6,000 car. When you're driving a $6,000 car that's in good working condition, it's not going to lose that much more value in a year or two. So in 2 years, you're going to have $14,000 worth of cash and a $6,000 car that you can sell. Now you can go out and buy yourself a $15,000, $16,000, $17,000 car with cash and not worry about making any payments. This is where some people get kind of upset and they say things like, "Oh, Jaspreet, you don't know anything about cars. If you just buy the right car, it will appreciate in value and then you can sell the car for a profit after you're done driving it." Sure, but that's the exception. That's not the rule. It's kind of like saying you can lose weight by eating at McDonald's. Yeah, in theory you could if you're weird and you eat this certain salad that they don't even have on the menu. Yeah, I'm sure you could lose weight by eating at McDonald's. But that's the exception. It's not the rule. Most of us are gonna gain weight and get fat if we eat at McDonald's every single day. Just like how most people are gonna lose money on their cars by driving a new car. If we're talking strictly financially, it makes a lot of sense just to buy a car that's 2 years old, because now you're getting a car that's relatively new and you're not paying top dollar for it because you're buying it at a huge discount off of what it was selling for just 2 years ago. It's still hopefully in good working condition because it's still pretty new and you're saving a whole lot of money. But that doesn't answer the question in this video, because the question is, when does it make sense for you to buy a new car? In order to understand that, we really need to take a look at assets versus liabilities and understand where your car actually lies. If you're subscribed to our YouTube channel, you've heard me talk about assets versus liabilities before. If you're not subscribed to our YouTube channel, you should probably do that. But assets are things that put money into your pocket. So these are investments. These are things you buy for the sole purpose of making more money. So when you buy stocks, you buy real estate, you buy other investments, these are things you're buying for the purpose of making money. Because when you invest your money in the stock market, you're hoping that the stocks that you're buying will go up in value and make you more money. When you use money to buy real estate investments, you're buying it that way you can make passive income, cash flow, and you're probably hoping that the value of your real estate will go up too. So when you're buying assets, you're hoping that this thing that you're buying is going to go up in value and make you more money. Liabilities are the opposite. Liabilities are things that you buy that don't make you money. These are things that just take money away from you and they don't make you any money, because as soon as you buy this thing, the value of the thing that you're buying is dropping like a rock. So these are things like clothes. As soon as you buy yourself a brand new $100 wardrobe, you're not gonna be able to sell it for anything near $100. This is like a vacation. If you buy yourself a $5,000 vacation, you're not making any money off of it. This is like cars, because as soon as you buy a new car, the value of the car is gonna drop like a rock. I just showed you that. So cars fall here in the liability side of things. You're driving a car for a utility. You're driving a car to get from point A to point B, and it is a liability because it's not making you any money. So what you want to do is, when you're building your wealth, you want all your money here. You want to buy as many assets as possible, because these are things that are going to make you wealthy. These are the things that are going to make you rich, and these are the things that are going to make you financially free, because if you're spending more of your money here, then you have more of your money coming back and you own more things that are making you more money. The mistake everybody makes is they spend their money here and they try to justify these liabilities by selling these liabilities to themselves in their brain as assets. They say, yeah, you know, this car might be able to make me some more money in the future, or if I drive a nice car, I'll be able to make more sales, or if I have a nice wardrobe, yeah, it's gonna make me look better and do better in interviews. But if we're talking strictly financially, these liabilities are not things that are going to make you more money. Sure, driving a nicer car might make you more presentable. Having a nice wardrobe might make you look better in interviews, but are they actually going to make you more money? Is your car going to make you more money? Will you be able to sell it for a profit? Chances are no. So stop trying to sell yourself these liabilities as assets and understand what an asset is and what a liability is. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. The first and should be most obvious point is if you want to buy a new car and you have to finance it because you don't have the cash to buy it outright, then you should not be buying a new car. You can't afford it. Buying a new car is the ultimate luxury, okay? It doesn't matter if you're driving a brand new Benz or a beat up Toyota. Both of these cars are going to take you to work just fine. You're not going to get to work faster and you're not going to be more efficient in your work. Both of these things are going to take you to work. One is just going to give you a more enjoyable experience. It's kind of like flying first class. When you fly first class from New York to California, you're going to get to California just like you did with Spirit. It's just going to be a more enjoyable experience. And so now, if you want that luxury, that's fine. You just got to make sure you can afford it first, because that money that you're putting towards this luxury could be used to build your wealth. And so if you don't have that wealth built first, then you got to be using your money to build your wealth before you're buying luxuries. For the majority of Americans, you should not be driving a brand new car. That money would be much better served going into your assets, your investments, instead of a car, which is just eating your money. This is what's keeping the majority of Americans broke, because they think they can afford a brand new car, but you can only make the monthly payments. There's a big difference between being able to afford a car and being able to make the monthly payments. So if we're talking about buying a brand new car, not a used car, but a brand new car, we're talking about you buying a luxury. If you want to be able to afford these luxuries, you really need to be able to afford it and not be stretching yourself to be able to afford a luxury. So if you want to buy a brand new car, you got to follow the rule of 5. If you can't buy 5 of them, you can't afford one of them. So that means if you want to buy yourself a $50,000 brand new car, fine. Just make sure you can afford 5 of them. You better have the cash ready to afford $250,000 worth of cars before you can buy yourself a $50,000 car. If you don't have that kind of money, then you shouldn't be buying a brand new $50,000 car right now. Your money will be much better served going into assets being invested on your behalf. That way you could build this wealth. That way, when you want to actually buy that car, you can afford it because you have used your money to buy assets before you're throwing all this money into liabilities like a car, which isn't making you any money. If you want to buy a really expensive brand new car, you want to buy a supercar, that's fine. There's nothing wrong with that. You should want to do those things, but you got to just make sure that you can afford it, because you need to understand what a car is. A car is a money pit. And so if you want to buy a money pit, fine. You just got to make sure you have the money to be able to afford the money pit and have it not affect you. If it's going to affect you financially, or if you're going to have to stretch yourself to afford this car, you shouldn't be buying this car right now. Right now, you should be buying something used with cash and take the monthly payment that you would have paid and pay yourself, buy yourself some assets, buy yourself some investments. That way you can build your wealth so you can afford the dream car that you want and not have to worry about the price. Let's face it, the majority of people don't always make the best money decisions. I mean, oh, where did this $50 bill come from? Must be garbage, it was in my pocket. Anyways, my goal is to help you make less of those bad decisions, and in this video, I'm gonna be going over 5 things that you need to stop doing. Now that I got my $50 back, have you ever looked at your friends' spending decisions and wondered, wow, what a dumb way to use your money? Are you kidding me? I judge my friends all the time. Well, how many times do you think your friends are secretly judging you? Did Bunty really just spend $500 on a new PlayStation? He's $20,000 in credit card debt. Some bad financial decisions are more obvious than others. That's why in this video, I'm gonna be going over 5 dumb ways that people use their money, some of them from personal experience. That way you do not waste your money doing these 5 things. First, you get so used to the spending that you don't know what it would be like to not spend your money. Has this ever happened to you? You go to the mall to buy a pair of jeans and you think it's gonna cost you $100, and you go and buy the jeans, and that's when you find out the jeans are on sale for $50, so you got to save $50. Now you have this extra $50 in your hand and you tell yourself, I'm going to take this extra $50 and I'm going to put it in my bank and save it, or I'm going to take this extra $50 and I'm going to invest it. Yeah, well, lots of people say that, but not many people actually do that. People in America don't like the idea of taking extra cash that they thought they were going to spend and then saving the money or investing the money. Instead, they like to take this extra cash that they thought they were going to spend and they spend it. What do you have on sale for $50? Oh, that's $75. I'll take it. Studies show that when gas prices fall from $4 a gallon down to $2 a gallon or below $2 a gallon, people could save $10, $20, $30, $40 a week depending on how much you drive. But what actually ends up happening is people create this imaginary budget in their mind where they think, oh, I have to spend $50 a week on my gas, so when gas prices come down, people actually end up spending more money on gas because they start using premium gas because you have this imaginary budget that says you need to spend more money on gas. So gas prices come down and you make up for this discount by pumping more expensive gas. I have no use for an extra $20 a week anyways. Credit card debt in America is breaking a record high, and almost half of Americans have credit card debt, and the average American who has credit card debt has over $6,000 worth of credit card debt. So that $10, $20, $30, $40 you could have saved every single week could have saved you a ton of money in interest on your credit card payments. When you create this imaginary budget in your mind where you tell yourself you need to spend $50 a week on gas, it's very hard for people to only spend $25. So you need to break out of that system, start saving that cash and using it to build your wealth. Second, don't confuse your liabilities and assets. An asset is something that makes you rich, and liability is something that keeps you broke. So assets are things like investments, stock investments, real estate investments, things that you buy for the purpose of making money. Liabilities are things that keep taking money away from your pockets. When I was in high school, I was making pretty good money for a high school kid. I mean, I was working at Auntie Anne's Pretzels, so I was making pretzels and working the cashier. That was like my regular hourly job. I also worked at weddings on weekends, and I was kind of starting up my own event planning business. So I was making some decent money as a high school kid. It wasn't a whole lot of money, but for a high school kid, it was pretty good. And when I made this money, I would invest my money into my car. Anytime I had some extra cash, I parked this money in my car because I just wanted to have a sweet ride. I drove a Toyota, and one of the first things I did was I put on custom rims on my car, then I put on tints on my car, and then I got the sound system put in my car, but I didn't pay the $99 to upgrade it. That way I could have Bluetooth in the sound system because I didn't know what Bluetooth was at the time. Then I put subwoofers on my car, and then the first time I had $4,000 in my bank account, I was gonna go out and put Lamborghini doors, those butterfly doors on my car, the ones that go up. But my cousin was like, Jaspreet, you're an idiot. Don't do that. I used to watch a lot of Pimp My Ride when I was a kid, and it was all about customizing cars. And thankfully, I was not driving around in a Toyota with butterfly doors. I spent probably thousands of dollars on my car thinking I was investing this money, but I was actually investing this money into a liability, so it's not really investing. But all that money went nowhere because the car became worthless. But if I had actually invested that money into an asset, something that makes me money, well, then I would have turned my couple $1,000s that I invested into my car into something a whole lot more, because every dollar you spend on something that is a liability could be worth $2, if not a whole lot more in the future. So if I spent $2,000 upgrading my car, yeah, I spent $2,000, but I also lost out on the opportunity to make $4,000. The reason I say that every $1 you spend on a liability today is $2 you could have in the future is because if you invest $1 today and you get an average rate of return, that $1 will be worth $2 in a decade. Third, you save all your money. This one goes against pretty much every Indian person's teachings, because every Indian person teaches the kid that you need to make $1, that way you can save 80 cents and spend 20 cents, because the Indian mentality is to save, and spend as little money as possible. I'm speaking from personal experience here. Growing up, spending unnecessary money was almost as bad as doing drugs, so you can imagine how people felt when they saw me spend money on my car. You said the video game is $50? Yeah, I'll take that. What do you think you're doing? Oh, nothing. I was just doing some drugs. Okay, I thought you were wasting money. Wait, what? I don't do drugs, I don't drink, I don't believe in doing any of that. And maybe that was a little bit of a stretch, but in an Indian house, you were kind of raised with the saving mentality. Now look, saving money is better than blowing all your money on video games and clothes and cars, but saving money isn't using your money to its full potential. Everybody needs to have savings, okay? You need to have an emergency savings fund. If you do not have any money saved for emergencies, then the very first thing you need to do is save money as fast as possible. That way you can save some money for emergencies. Once you have some money saved for emergencies, once you got 6 months worth of expenses saved, now it's time for you to really use your money. If you save an extra $10,000 when you're 20 years old and that money does nothing except just sit in your bank, you are losing out on the opportunity of having $200,000 when it comes time for you to retire, because you could invest that $10,000 instead. Time is so important when it comes to investing, because if you take that $10,000 and you invest it when you're 20, by the time you're 65, that $10,000 can grow to over $200,000. But if you start when you're 30 and you take the same $10,000 and you invest it, now that $10,000 is only going to grow to $100,000. You need time on your side. That way you can grow your money and build your wealth, but that will never happen if you are saving all of your money. The longer you invest your money, the more aggressively you invest, and the more money you invest, the more wealthy you will become, which is why you need to have savings, but you need to also be investing your money. Save enough money to protect your finances. That way you never have to worry about going into debt when an emergency happens. Once you do that, you need to start investing aggressively. That way you can really build your wealth. Fourth, you don't value your time. When you're in college, $1 is very valuable. And one thing that I thought was very interesting was how much people were willing to sacrifice to save $1. Or I guess in this case, $3. On my college campus, there was a Ben & Jerry's ice cream parlor, and every single year they would do this promotion where they would let you get a free cone of ice cream. I think it costed like $2.99 if you bought it. But if you come on the specific day, they will give you a free $2.99 ice cream. I think that price is a little bit deceiving though, because if you go and get that free scoop of ice cream, they don't give you a whole scoop, they only give you half. But people would get so excited behind the idea of getting a free cone of ice cream that they would stand in line for 3 hours. That way they could get a free cone of ice cream when you're only getting $1.50 worth of ice cream. Now look, I'm an entrepreneur, and from a business standpoint, that is amazing marketing because Ben & Jerry's gets so much buzz and so much PR giving people free ice cream cones. But let's look at this from a financial standpoint. You are trying to get a $3 ice cream cone, I rounded it up, for free, and you're waiting in line for 3 hours. So if we do the math, $3 for 3 hours, that means you are valuing your time at 3 divided by 3, $1 an hour. Now I know you're just a college kid, but still, I think your time is worth a little bit more than $1 an hour. But this doesn't just happen when we're in college. This happens all around us. How many times have you seen your friends spend hours and hours and hours trying to find a coupon so they can save $20? Or how many times have you spent months trying to figure out how you can save an extra $500 on your car? Saving your money is great. You should always try to negotiate and get the best price possible, but you also have to value your time. If you can make $20 an hour at your job, is it really worth 30 minutes worth of your time to save $5? Sometimes it's better for us to pay a little bit more and spend our time earning more money. That way we can grow the pot and have more money and then worry a little bit less about the price. Fifth, you let salespeople make your financial decisions for you. I used to be a real estate salesperson and I was the worst salesperson there was. I don't mean to brag, but I'm pretty good at real estate and I'm pretty good at selling, but I hated the idea of selling something to someone that they couldn't afford. I'm a financial person and I'm always thinking of affordability, which is why the sales process for me was kind of really hard, even though I love selling. Sales is a lot of fun. You get to learn about persuasion and you get to learn about people and you get to help people make buying decisions, but salespeople are not in the business of looking out for your financial health. A salesperson's job is to make money. Not for you, but for the company that they work for. When a salesperson tells you that you're getting a great deal, what that means is it's a great deal for their commission check. It's the same with your bank. When you go to the bank and you ask them how big of a loan can you get or how big of a house can you afford, their job is not to look out for your financial health. Their job is to make money. Not for you, but for the bank. You need to be a salesperson for your wallet. Your job is to keep more money in your pocket because your job is to make yourself the most money. Now, this doesn't mean that all salespeople are evil or that they're bad. This is the business that they're in, and so you need to understand how to protect your finances. That way you can build your wealth first. If you really want to become wealthy and have millions of dollars to your name when you're young, then there's really one concept that you have to understand. Now, most of the time when we talk about investing your money in your 20s to become wealthy in your 30s or 40s, the thing that we're talking about is investing your money for the long term, having time on your side, compounding your profits. But that's not what I want to talk about in this video. Now, these